David was on our show April 19th of last year. His first top pick was Bank of America. Not a bad return, 43%.
Yeah, I would buy Bank of America today at the prices we're at. It's a little over 1.2 times book value. It could trade, that assumes if you sold off all the loans today, you get your money back without paying anything for the brand, without paying anything for the growth. The book value is growing north of 15%. They're going to return significant shareholder capital to shareholders this year, and they benefit from rising interest rates and a number of other things. So this is a long-term story. You could own this for many years.
Adobe, 65% return. I remember Steve Jobs, when he was at Apple, used to be at odds with Adobe over the years.
So Adobe is the classic company that went from selling releases from time to time to selling software as a service and getting paid every month. And so arguably you should be paid a higher multiple of earnings for something that predictable. And they've been able to capture market share. They are, the absolute dominant leader in digital media, which of course is growing like topsy. And so again, this is a company we continue to own. I would continue to buy. We invest in structural shifts in the economy that go well beyond the business cycle. So if the economy grows from 3 to 2, the growth in digital media is not going to slow down. It's going to continue to grow. And all of the themes we're invested in are structural themes that go well beyond the business cycle and could go on for many years.
Yeah, because Adobe, it's so interesting, isn't it? The software companies have really, the penny dropped for them. Yeah, why not charge the customers just regularly and have them on a drip forever?
Well, and especially if what you're selling are the tools to build digital media that goes to feed the internet, right? And that's what Adobe does. So really, the software that they're selling helps companies to create the material that they're populating Twitter with and online advertising and all of that stuff, along with other things. And that's a secular growth area that will go on for years.
And presumably it makes it easier to update the software rather than people having to download patches and stuff.
Oh yeah, and of course they also sell the things to track whether they're getting traction with the marketing that they're doing. Mm-hmm. So all kinds of other pieces in that infrastructure area.
Now Ingersoll Rand, the great engineering company, not a bad return, 7%. Stock now trading a bit above $86. You got out at 85 and change.
Yeah, we got out at $85 in August. We had continued to have a very significant industrials weight, but this was one that we came out of as we topped up our defense stocks.
Oh, you did a move partially from industrial to defense stocks?
We've been in defense stocks for about 3 years. We've talked about many of them on this show, but we've continued to ramp them up because they continue to perform well, and it becomes more and more visible that buyers from around the world are continuing to build bigger and bigger backlogs.
So it was more of a sector thing that you sold out of Ingersoll Rand?
That's exactly right.
Oh, okay, not particularly misgivings about the company?
No. We think it's a great company.
Right. Okay, we've got to take a break. David Burrows is our guest on Market Call today, President and Chief Investment Strategist at Barometer Capital Management. David's taking your questions on North American large cap stocks. Maybe we got enough for the junior miners at PDAC this week. David's not doing those today. Give us a call, 1-855-326-6266.